Hello, everybody, and a warm welcome to all of you from Seoul, from the European Chamber of Commerce and Korea. It is a pleasure to welcome you today to another session of the ECCK Sustainable Development Goal webinar series. In fact, the fourth edition, after having Baker Hughes, an energy company, BASF, a chemical company, Lego, a toy company, and today we have Swiss Re, a financial company. This morning I met Ban Ki-moon, and somehow is the godfather of our webinar series, and he came up with a new statement, and he said, against COVID-19 we have a vaccine, against climate change we don't. That's why it is so important to keep this topic, Sustainable Development Goal, ESG, climate change, however you name it, as timely as possible, and also it is important to act now. Today, I have the privilege to welcome Guido Fürer, the Chief Investment Officer of Swiss Re and member of the Group Executive Committee. Before we move to Guido, I very briefly would like to explain about the procedure. So Guido will share his insights about Swiss Re's sustainable journey for about roughly 40 minutes. And then we have about 20 minutes time for Q&A. There is, I think at the bottom of the screen, there's a chat box. So if you write your questions in there, then we will be more than willing to share the questions later on with Guido, who will be definitely very open to answer those questions to the best degree possible. So without further ado, I would like to hand over to Guido now. Guido, the stage is yours. Please start.
Thank you very much, Christoph. It's a big honor, and I would like to welcome everyone. Big thank you to the European Chamber of Commerce in Korea for inviting Swiss Re to talk about a topic which is really very close to our heart, to our DNA, and it's always a big pleasure to talk about something which we are really kind of passionate about it, and it's also about it's not 10 years anymore until we need to reach the 2030 United Nations Sustainability Development Goals, and 10 years, as we know, will rush very, very fast. That's why good to think what can be addressed now and not only in the last minute. But we know Sustainability Development Goal has a very broad type of offering, and more recently, I think the focus, I guess, of many of us has been on pandemic, COVID challenges, and but that's why it's good also to still keep that momentum up, and also very good to hear, as you mentioned, Christoph, maybe there's some light at the end of the tunnel, and that we have sufficient, I guess, vaccination mitigation to fight it down. But the climate will stay. I always say climate challenge, but also more broadly sustainability. This is not the sprint. I think the COVID piece was kind of a sprint, and yes, we showed that within a year, our society, the human beings, could develop a vaccine. No one has expected this ever before. Usually you need, as we know, years, and that's why if humankind is really kind of aligned and kind of share some common goals, but also ambition, you can move much more than what we, I think, naturally would think of. With that, I would like to quickly share a presentation, which allows me then to highlight a few kind of topics. As already mentioned, Swiss Re is a reinsurance company. Just one slide about us, maybe for people who are less familiar with our industry. Swiss Re is a reinsurance company by one of the biggest. It's truly global, and we basically make sure that risk is not only kind of talked about but also addressed. That's why our primary kind of contribution is we call it risk transfer. That means we take over risk from other participants, from other insurance companies, but also from global companies. But also we provide risk insights, and I will share a few examples afterwards with you Because again, it's not only transferring, but also sharing what type of learnings we have in certain class of risk. And ultimately, it's also risk partnership. That's why we always look for people who are best in class, companies which may be very deep in certain markets or in certain research topics, and basically team up so that we can offer more value. The phase to the market, let's put it this way, is kind of threefold. We have, as already mentioned, reinsurance as our big offering, covering both property, casualty, but also life and health. But we also focused on kind of the specialized risk partners in the corporate space. And we have also a B2B2C offering, which is called ECCK, where basically we help different distributors to have the right risk approach in the value chain. This is the phase basically to the market. Now, also Korea is an important market for us. We have a branch there. We are there for many, many years, and that's why we cover many countries on this globe. And this is also one of the main value proposition. We can help to diversify risk not only within a country, but also on a global scale. But let me coming back to kind of sustainability goal and what is our approach? First of all, we try to find out which are the material sustainability topics for Swiss Re. We have many goals, and that's why it's good to focus on the one where we can make the biggest change. We were contributing right from the beginning in 2015, and also we map our own ambition towards the goal. We also try to kind of make the differentiation what insurance can contribute to reach to the reaching of these goals. And ultimately, it's good to map ambition. It's good to also kind of sketch out goals, but it's also important to measure action, and that's also part of our regular kind of routine, clearly always in our corporate reporting. That sustainability is not just a topic since 2015 shows this graph, and if you go back to our own kind of archives, I think the first publication which we did was in 1979 about sustainability, and since then there was a constant, I guess, learning and going along the journey. And yes, we joined PRI, Principle of Responsible Investing, but also the Principle of Sustainable Insurance, and more recently even New Alliance, which is support. And that shows Swiss Re tries to engage also with similar-minded companies, but also with multilateral organization to make sure that we have also the private sector input in defining not only ambitions, but also the way how we reach those goals. Now, as I mentioned, we also try to provide insights to society, to the market, and a very recent study, which I think is quite interesting, was published 2 or 3 weeks ago by our Swiss Re Institute. And the question which we kind of posed to them was, what is the impact on climate change, which is one part of the whole sustainability discussion. Now, climate is very close to, I guess, to our business. Swiss Re is the biggest natural catastrophe reinsurance company globally. That's why global warming, natural catastrophe, which are linked to global warming, has a direct impact on our bottom line. That's why we invest a lot in research. And the question was now, if we don't move, if we don't have any mitigation, what is the impact? And you see in the title, we believe the GDP could be lower by almost 20% by 2050 if we don't act. Now, if you express this in a dollar amount, and again, if you try to estimate GDP by 2050, we believe this could be a 30 billion, a 30 trillion amount, which is enormous. And that's why whatever we can do to avoid those drop of 30 trillion is probably is a good investment. Now, what we also showed that the impact is very different depending on the region, depending on the area. I also tried to, in preparing for this presentation, what it means for Korea, and you see it on this slide. It's about in the middle, as we looked at 48 countries which represent 90% of global GDP, and Korea is probably somewhere in the middle area. What we estimated is the physical impact, and it's clear if sea level is increasing, yes, certain assets and certain parts of our society are at risk. But it's also physical impact also goes beyond that. Yes, we will have more flooding, we will have more, I guess, storms and other kind of hazardous events. And if we estimate also the damage and the losses, we come up with this very high figure. And the third dimension, besides physical risk, is a transition. The certain countries have a much higher transition risk if you go kind of a low carbon economy than others. And again, if a country is vulnerable and does not move, you have much more, I guess, stranded assets, but also you're maybe much more exposed to business interruption, particularly if you're integrated in the global value chain. And that's why Korea is, yes, it's probably in the middle according to our estimate. I try to dig out the GDP impact. We believe if there's no action in respect of climate, and again, if you assume we have a global warming of 3.2 degrees, the GDP impact on Korea, South Korea, is minus 13%, which is still a meaningful figure. That's why it's worthwhile to keep that downside in mind when we talk about action. And I think the next slide shows you a bit, besides climate, which is clearly one of our top ambition in respect of sustainability development goal, we also building on societal resilience, and I'm coming back to that in a second. But also one of the sustainability goals is to offer affordable insurance and digital solution. And our principle in respect of these goals is clearly to embed them in our daily business, so that we don't have them somewhere on the side, but making sure that we integrate them whatever we do as a company. We also try not only to be kind of a follower, we try to lead certain topics where we feel to be close enough to make a difference. And as I just had an example for, we also try to quantify, because insurance, one of the nice things of insurance, we give prices to certain risk, and always think if you have a price signal, this can of course impact both behavior but also the marketplace. If I look at the Swiss Re sustainability ambition and try to map it into the SDGs, you find this overview. Again, the first one, the climate related, of course, has a direct impact on the climate action, the number 13, but also on the number 7, affordable and clean energy. And that's why it's important to translate our goal into the mapping of the sustainability goals. And it's our own mapping. And it shows a lot of connectivity. You see, we look at many of the 17 goals. In respect of governance, this is not somewhere, again, done in a small team. This goes to the top of the company. We have a group sustainability framework, which has been approved by and also supported by our board of directors. It's also compensation relevant. That means we have hard KPIs in our target for the company. And that's why we closely monitor, are we at the target, below or above? And it has a direct impact also on the assessment, how good we are doing as a company. The group executive committee, they are basically responsible for the implementation of the group sustainability framework. And we also created the specific sustainability council. And that's probably, from an operational point of view, that's probably the most important body, because there we brought all, I think, experts, there we brought all kind of P&L owners, which have a say and impact on reaching the sustainability goal together. And they meet on a regular basis. This is not top-down driven, this is bottom-up driven. And the real kind of action happens in that council. It's a debate between, okay, if we now reduce our own carbon footprint. What is the impact in serving our clients? What is the impact on the internal kind of mechanic of the company? That's why you need somewhere to have this healthy debate about pro and cons of each and every measure. That's why we kind of formed this Group Sustainability Council, which is now in place since several years, and very important aspect for our own consideration. Now that sustainability is a main topic, not only in the franchise building of companies, but also in the financial market, shows sheer size. I think you all follow the ESG trends. It's a huge momentum in financial market. I think there's no other kind of theme or no other kind of activity which attracts so much funds. And we have already, according to the Morningstar estimates, already 1.7 trillion managed under this environmental, social, and governance label. Also interesting, last year, which was clearly from a financial market point of view, also one of the most volatile markets ever in both directions. We had a massive deterioration in financial market back in February, March, April. And then probably one of the quickest recovery ever in financial market. And that's why there was, in my view, no other year which showed the same level of volatility in both directions. But even in the height of the crisis, the only inflows which we could observe was in so-called ESG-focused funds. And that's also interesting. In a crisis like we had and still are in many parts of the world, ESG is not neglected. It even found support to continue to invest. That shows it's a trend which is also kind of a crisis-prone, and which will not disappear, as we all know. That's why it's worthwhile to also embrace it, both from an investor, but also, I guess, from a creditor point of view. If I look at our own portfolio, and again, that's my kind of main responsibility since Swiss Re, being the Group Chief Investment Officer, we embedded sustainability goals very early. And again, besides being a member of PRI and also joined the task force of the Financial Stability Board, which defined the DCFD, we also implemented a very important item in our own portfolio. And probably the biggest change in my time of heading up asset management Swiss Re was the change in benchmark. And whoever is in financial market knows benchmark is probably the most important decision which you can do as a company or as a portfolio manager. And we switched all our benchmark from the former more commercial normal benchmark to ESG benchmarks. That means we measure each and every portfolio manager if they basically beat or underperformed relative to an ESG benchmark. And we did that consistently at 2017. And we were clearly the first one in our industry, and still probably one of the few ones which has done the full switch to ESG. And I just want to quickly share two figures with you, and to see that it has really worked out. And last year, again, this was probably the test which you can just dream of in both directions of market. And in those market, in equity, we had an outperformance on the equity side, risk adjusted. This is expressed in Sharpe ratio on a relative base by 12%. That means our ESG portfolio basically behaved 12% better on a risk adjusted basis than the former more commercial benchmarks. Credit, and I'm talking about investment grade, the difference was 10% on a relative base. And this is a lot. Again, in financial market, these are not small differences. And I say it's risk adjusted. That's why it doesn't look only at return, but also how much capital you need. And in our world, basically, the more volatile something is, the more capital you have to underpin. That's why it really worked out, and we will do it again, the same switch. It works from an economic point of view. Now, it's not only the figures and the relative performance, it's also about action. And we also thought how we can make also a meaningful impact, not only for our own portfolio, which has a good size and where we can do something, but we knew we can only make the big shift if we kind of line up with similar-minded investors. And the alliance which we co-founded last year is we call it Net Zero Asset Owner Alliance. And we have now 38 different members. Also, some of them are from Asia and many others. And there we committed jointly that we have a net zero emission investment portfolio by 2050. It's a nice target that many countries and many companies have the same one. But we try to make the distinction what we can do in the more shorter term. And probably in 2050, I will not sit anymore in front of a camera. That's why how I can be credible as a leader. And that's why we took the challenge within the alliance to find an agreement and I can tell you this was quite a negotiation, but we ended up that each of our members has a reduction by 25, which is about in 4 years between 16 and 28%. You see, it's a range because it's negotiation. Some companies, some investors, they have higher challenges. Again, if you're in certain, I guess, emerging market, there's a much heavier dependence on certain CO2 intensive industries. That's why we try to find a global compromise. But other companies, they go even further. And Swiss Re, we try to set the bar really high for us. And we decided to have a reduction by 25 of 35% in our equity and corporate bond portfolios, which are the highest which we have. And this gives you an idea of how serious we take this. And again, a continuation of the journey which we have started already in 2017. But also we go into specific, I call this is very focused investment, be it renewable, social infrastructure, but also green bonds. But the big shift you do through the benchmark adjustment. We also will report about the progress. That's why we have been public about our ambition. And whenever we have a possibility to report, be it on the annual basis, the corporate responsibility report, but also on other occasions, we always tell how far we are on the journey and what the kind of the effects are. Coming back to the SDGs, here just an example, and this is more for illustration, and it's not complete. But if you do kind of thematic investments, you can translate it into something which is directly linked to sustainability goals. And for example, if we invest in infrastructure alone, and yes, we do renewable energy, I can say it is about 5,000 megawatt, or again, I could finance 1,200 hospital beds, 66,000 affordable housing units. These are just examples. And same on our own real estate, how much green real estate we could build or kind of renovate. This is also quite interesting to translate things which we do on the insurance side, or in this example on the investment side, into sustainable development goals. And it has also, it's not only good to have a few additional figures, it's also to show to our own people and to my own colleagues in asset management, okay, if we do investment X, Y, Z, what does it in respect of our sustainability goals? How much additional schools maybe we can support? How many students basically can be kind of supported by attractive facilities and learnings? And that's why it's very rewarding. It's a bit of an effort, but it's doable, and we do it relatively consistently. Same also on the insurance side, and it's also something which we just discovered how meaningful it is if we start translating it to tangible and direct links to sustainability goals. Now, what lies ahead of us in respect of the climate and the net zero ambition? On the reinsurance side, we have put down the ambition to exit thermal coal. we make a distinction between the developed world. There we are tougher. By 2030, we will not support any thermal coal policy anymore. For countries which are in a more challenging situation, developing countries, we define 2040. And you see a bit, I think our approach is not to have kind of the big bang and that we completely exit certain sectors. We believe the right thing is to help to do a transition from a more former economy to the new one, which we all need. And for that, we need funding. And I think being an insurance company, we can set signals on the pricing side and the premium, but also the capacity. And on the investment side, similar thing, we can start putting certain restriction on certain activities, but the ambition is always not to avoid any sectors. And if I mentioned before, we moved into the ESG benchmark, we did not exclude any of the sectors, even energy, utility, and commodities are still part of our investment universe. But we started to basically redirect within the sectors to companies which we believe are more successful in mastering the transition. And that's also, it's a different approach than just selling everything and exiting sectors. I think that's not the answer, particularly if you believe in the sustainability goals, because there we know we have a social challenge, we have a lot of inequality, and we have very different situation across the globe, and that's why exiting sectors and even avoiding countries is not the solution for the challenge which we have. And we try to express this in the mandate which we give to ourselves. Then on our own operation, I think that's probably easier for us than maybe if you're somewhere in the production. Of course, we go net zero, which we already now are, but again, we buy kind of a emission certificate, but we want to be real net zero by 2030, including scope 3. And to give you one example to achieve this, we put internal charges, levies on any CO2 emission activity. For each ton which we emit from our own operation, you get a charge of $100, be it on the heating, if you use this, or on the traveling, etc. And that's, I think we are, as far as I know, we are one of the few global companies which charge $100 for internal. And we go even further, we charge $200 by 2030. Now it's kind of a constant increase to $200. That means each of our business leader within Swiss Re, they have now all reason to think, okay, my activity, how much CO2 basically I produce? Do I need really to travel to that place, or can I do a video conference as today? Do I need to travel by 2 person, or is 1 person sufficient? Can I combine things? And with other words, you give incentive to people to start think twice if you have any CO2 related activity. And it already starts to show evidence, and people start to behave different, they start to plan different. The proceed out of this internal levy we use for basically green investing, kind of that we have kind of this recycling with our own company. Now let me kind of move to the broader picture, not only talk about sustainability development goals and Swiss Re. This is a joint challenge, and we know as a single company you can make just a marginal difference, but it's together as a private sector, it's together as a sector, it's together as a country, you can make the big difference. And that's why we do kind of as good as we can for our own company, but it's important to also show leadership in explaining how you do it, also share learnings, and we do this very actively on across the whole company, but also engage in important kind of platforms like today's. This is for us an opportunity to share our passion, our ambition, and Swiss Re's mission is, yes, we want to make the world more resilient, and it's not only a casual saying, we really mean it. And And it's not only through offering insurance solution, which should help stabilize certain things and the risk sharing, but it's also the way how we act internally and the way how we invest. But it's important that we find kind of framework which kind of works and can be applied across the globe. That's why we need partners which help us to navigate certain things and also find good sustainable solution. But also working with multilateral organization because they again have a big importance in moving the resources. This is not only financially, but also its brain, its time towards the right direction. And that's why everyone can contribute. And always say such type of platforms like such a chamber is super important to learn across different industries and different location. And ultimately, that's why I think the Sustainability Development Goals, as also our climate goals, this is probably a perfect investment case for all of us. And maybe that's also the closing of my remarks. So that if I say we can avoid a drop of 18% in GDP with a bit of additional investment, and the OECD did a back on the envelope calculation. Right now, we invest globally 6.3 trillion annually for infrastructure. If we add 10% more, that means another 630 trillion, we will achieve the net zero jointly. And if I can, with this additional 10%, if I can avoid a drop of 18% or the 30 trillion, you see that's probably one of the best investment cases which I ever saw in my professional career. That's why it's not only about for kind of doing good. This is probably the investment case, and the same is true with Sustainability Development Goals. If you can address them, we have a much, I guess, more balanced economy, something which is much more broad for resilient and has much less downside. And on that, I think positive note, I wanna close this presentation and move to a Q&A.
Okay, Guido, thank you very much. Yeah, and I think we have already, some questions from the participants. Sorry. Yeah. I think the first one is from Andre. It's good to learn the reality about industries which, unlike oil and gas or chemistry, do not intuitively sound as having a major role to play on sustainability. However, should the insurance industry simply decide not to cover clients who do not care about ESG goals, would this be a strong incentive for these to change their mind? Yes or no? So pretty direct question.
Yeah, I think as an insurance company, particularly if you're perceived as a kind of a good example and maybe also has some impact on the behavior, you can give a lot of signal, and we do give signal. For example, if we insure anything which is CO2 intensive, this has a different price. And I mentioned before, I think the beauty of insurance, we put a price label to any type of risk. If we don't insure anything, there must be a very good reason. Either again, it's we don't have an alignment of interest, or we just don't know what the outcome is. Or there's no way that we have a sufficient model to get an idea. But if we start to kind of communicate, which we did, that we will exit thermal coal policy by 2030 for developed part of the world, and by 2040 also for the less privileged part of the world, this is a very strong signal, and it basically shows. Yes, we want to support the transition. We don't drop coverage on day one, but there's a clear kind of a time limitation how long we will continue this. And we have now also increased threshold. Again, if a company is above certain threshold in respect of revenue coming out of thermal coal production or operation, we also will not insure it. That's why we start with threshold in respect of revenue and then bring it down to basically no coverage anymore by 2030. And that's why we can give signals through price, which we do anyway. I think insurance premium, this is not the government-led type of tariffs. This is private sector. There's competition, of course, but also you that signals via capacity. Or if we say we only insure, to make an example, not $100 million anymore, but the maximum coverage is maybe 50 million, and we only attach at the first 20 million loss. You also start giving signals, and yes, we do this, and I think it's a very important message. And we also believe it's about credit risk, and we also looked a bit what is the impact on certain sectors, and the figures which we came up and also supported by IMF is that certain sectors, energy and again utilities, the impact on the yearly earnings could be between 40 and 80% if we had the full charge of carbon emission right now of $100. So in other words, the $100 which we apply internally, if this is charged to on a global, let's say global carbon pricing, this would have a huge impact on certain sectors. And again, the estimate is between 40 and 80%. That's why this has a direct impact on the credit risk and of a company. And these are, I think, signals which you can kind of read on the wall. And that's why it's in everyone's interest to think it through and have basically a transition plan.
Okay. So maybe still, let's say, following Andre's question. So I think what I hear sometimes is that ESG just has kicked off to be, and there's still a lot of different interpretation, different measurements, and so on and so forth. So sometimes even investors are a bit confused about, is this company really, let's say, fully in line with ESG, or let's say not really in line? It's more like that they have wrapped it nicely and let's say to present this as a green gift in the annual report. So do you think that we see a more, let's say, standardized ESG reporting, which also makes it more easier for Swiss Re to sort out, let's say, the bad companies versus the good companies?
Yeah, it's definitely, we need much more standardization. And again, it's a very fair question. It's anything else than perfect. And that's why, for example, we should have rating agency which really looks at the SDGs or climate risk in each and every kind of issuer, and also accounting. I always say, we have all kind of standards, be it US GAAP, IFRS, maybe also local stats. There are standards how we account for certain liabilities and certain assets. Why we shouldn't also have standards for liabilities, maybe which we have on the climate side or assets, and this is absolutely these urgently needed frameworks, and we have standardization both how we define certain things, how we report, how we monitor. And right now it's a bit, I would say it's everyone's kind of interpretation, which is not good. And that's why whenever I see kind of a global framework, which is maybe not 100% correct, but has a good direction, I try to support it. And again, the DCFT reporting framework by Financial Stability Board, it's not perfect, but probably it's as good as something currently is existing. Then also benchmark, which is the right ESG benchmark, and there's not the answer is not there's not one right one. We have looked at 6 or 7 different benchmark, really kind of deep dive. Yes, then we decided which one are probably the best in class. But now it's a constant discussion with the benchmark provider, because also then we need to learn, and it's not stable. Or if you move to ESG benchmark, it's not as stable as a kind of a standard MSCI or kind of JP Morgan, and that's why if you use this, it's clearly it's a journey, and we all learn. But I also want to encourage all of us. For me, it's no reason not to do it. Again, we did it, and I can tell you, to be an early mover also pays out. And the figures which I mentioned before in ESG, now it's a huge hype. It's an overcrowded market from investor point of view. And to be an early mover pays out, because yes, we moved early on. That's why we picked probably the right securities relatively early, and it pays out also on the return side. But for me, it's less the short-term kind of return differentiation. It's helping to have a framework. The more global a reporting framework or kind of a definition framework is, the easier for everyone. That's why to engage in certain kind of alliance or in certain multilateral efforts really helps to move things and bring things together, which I think it's the most important piece. I think that's kind of a long-lasting answer to a very good question.
Good. Yeah. So we have a couple of more questions from the audience. So Jonas was asking, say, what are the lessons learned from moving from the commercial benchmark to the more ESG? So you've said basically you have to monitor the development. It's flexible. You have to manage. But is there something else what you would like to mention?
I think besides a better risk-adjusted return, and by the way, I could convince our own board. Again, it's one of the earliest in our industry to move to ESG. I could only because I could show it in stats, and we quantified what the impact is. And the compromise which I did with them, yes, I'm allowed to move into ESG benchmark, but I still need to monitor my portfolio relative to the former benchmark and to show what basically left on the table or how looks the portfolio. That's why I did the extra effort to basically run the portfolio under two different kind of benchmark universe. But I'm glad that the board asked us to do this, because now I can always show the difference, and it's a very good one. But the other big learnings, and which is maybe even more meaningful, is the goodwill which we created with investors. And again, our chairman, which does regular kind of roadshows with our shareholders, again, he's one of the biggest supporters, because he saw how much this is appreciated by financial market, and particularly also by shareholders. Majority of our shareholders, they applauded us for being an early mover, and also to be kind of a party which not only does it for ourselves, but also tries to engage in society. And the other, I think, big learning was for me, and again, I'm also a few years now in professional career. If I look back my own 30-year time, this is my biggest kind of surprise. I never had so much engagement from my own people on this SDGs and on the climate and ESG topic. I had so many volunteers which wanted to help and again put extra time into analysis and use their own network. That's why in respect of engagement in the company, it's a no-brainer. And although again you go with your own team in a bit of uncharted territory, which we went in 2017, but it's so rewarding. And why it's not only the hard kind of financials and returns and risk, it's also about engagement of your own people. That was the other big learning which I quickly wanted to share.
Good. So another question from Natalia is, how do you measure the progress? So in financials, you have, let's say, the financial statements, you have the income statement, and you have 2020 versus 2019, etc., etc. Yeah? So how do you account for the progress on SDGs, or how do you measure the success? Are you on a good way? This is basically the question.
We always publish success in our corporate responsibility report across all ESG targets where we can add value. That's why, yes, we're monitoring it, and you can always be better. And I think I mentioned the carbon footprint. We have the ambition reduced by another 35%. We already reduced when I measure my portfolio 2015, before we switched to ESG, and end of last year, the reduction in the carbon intensity of the portfolio was between 40 and 50% already, measured in tons of emission in our holdings of issuer. Now, the way how we measure it, if a company reports the CO2 footprint, of course, we take the company specific, reduction. If I don't have figures, then I take a sector average, but the impact is enormous. And now what we try to do, we have internal figures, but not yet ready to release. We try to translate the reduction in the CO2 emission into the temperature score, which will be much more tangible for, I guess, everyone. Or if I can say, Swiss Re, we are our trajectory is on the whatever, on the 2.5 degree. Then we know we are not yet there. We need to reach clearly something below 2%, ideally 1.5%. I do now the same on my asset portfolio. So with other words, if I look at my asset portfolio today, do I reach the 1.5 degrees? And the answer is not yet. But I think if I continue to do the progress, which we showed the last 2-3 years, I'm comfortable that we will reach it. But I will be only successful if I know that the companies which I invest also do the transition. That's the big risk which I take. If there's no changes, of course, I will not make it on the investment side. This is one reason why we need to kind of help the companies to transition. And I have a lot of discussion with the companies which we invest in. I always try to learn from the best in class. For example, I visited also a few companies which are active in the transportation sector. Transportation is a very CO2 exposed sector, and learning from the best in the sector how it can be done helps me as an investor to ask for the right thing, maybe from others in the same sector. With other words, I try to find role model in each sector, use their learning and help maybe others which are less advanced in the respective sector. That's another kind of measure.
Okay. Good. So Joshua is asking about SDG Driven Investment arm investing within the Korean market. So are you doing this already, or you have plans, or you are investigating but focusing on other markets currently? So what do you do?
The question is about green markets, correct?
It's about investing. So I understand. So insurance, you receive premiums. You have to invest it short-term, mid-term, long-term, depending on the prospective cash flow out. And the money is, you have to invest. That's why you're the chief investment officer. And the question, I think, is from Joshua, are you already investing in Korea in SDG Driven Investment? Yes or no?
Yes, absolutely. Whatever we do, we map towards the SDGs. And in some SDGs, we have hardwired kind of KPIs, what we want to achieve. And that's why as we measure the full portfolio, but then also we go down to specific sectors to see what the progress is. We have also kind of designated kind of buckets on the renewable piece, how much we want to do in which part. And the good thing is we are a global investor, and we are active in 124 countries globally. And again, Korea is a very important market for us, and thanks God we have been in this market already for quite a few decades. That means yes, we are a local provider of insurance coverage, but also we are a local investor. This is true for many other countries. We always try to invest locally, just because of the currency, and and we try to avoid a big currency mismatch, and that's why we need to follow the progress and the opportunity in most of the countries globally. And within the countries, we try to find out which are the most attractive niches and opportunities in relation to our global goals. And if I say I'm an ESG investor, this is applied across the globe. Yeah.
So also still from Joshua, he had two sub-questions. It was actually, can you share, if it's not confidential, so can you share maybe your best ESG or SDG investment you ever did?
So we do also startups funding, and of course from a multiple you find extreme cases, and again we had again it's public, that's why I can share it. For example, we invested into a good doctor, which is a Chinese kind of internet-based distribution of medical advice. And I think this is not only relevant for China, but it's a global piece. So the medical advice, thanks to digitalization, allows to, let's say, reach people who don't have a doctor around the corner, and can profit from the global advantages in medical research. And that's why digitalization and some of the SDG goals, we clearly reached a new level. And just from a financial point of view, or if you can kind of connect things which are truly kind of linked to sustainable development goals with latest technology, and again digitalization and AI, it brings us to a different leap. And then if you apply kind of financial market kind of techniques, multiple, you get to very great investments. This is just a small example, but that shows for me it's not an exclusion. If you want to be SDG kind of focused and nevertheless be a successful investor, this is not kind of contradictory. You can combine it. You can be a thought leader in reaching sustainable development goals and nevertheless have a good track record as an investor. And we have also a sizable investment portfolio in Africa, to give you an example. Again, this is not straightforward. Quite often these are less liquid markets, as we know, but nevertheless it has a lot of upside. And these are just a few examples. You're not in it for the short-term return, but you help to building up something which is super powerful and could be super attractive in the mid to long term. That's the way how we use basically our resources, our balance sheet, just to give you a few examples. Okay, good.
So I would like to combine a question from Eric and from Simone, and maybe not identical in the same way as a race, but basically it's about the carbon border adjustment tax, about EU sustainable finance taxonomy. It's about EU regulation, about CSR reporting, and so on. So there's a lot of things happening. And so the question number one is do you think there will be a change between your investment allocation from Europe to APAC, or from APAC to Europe or to other markets? And do you think a more international alignment of rules and regulation is advisable?
The latter, absolutely. I think if you're a global company, I think you need kind of a master plan, how certain things kind of defined and also incentivized and encouraged. And I think if I have a wish list to policymaker, it's clearly having a global price for carbon. And it's nice if Europe has its price and US, but I think for global companies would be the best dreamland would be a global kind of agreement. That's why this year's kind of COP26 event, most relevant kind of countries, statesmen, but also private sector do join. That's the opportunity. That's why having a global price for carbon will set a lot of signals, and having a very fragmented world doesn't help, as we know. Now, if there's a carbon tax, again, it's about the level playing field. Although if the EU thinks, yes, we charge certain things for European companies, I think it has some fairness to also look at taxes, maybe for countries or for companies which are not exposed to the same levy or tax, to have a kind of a level playing field. But taxes is always kind of the second best answer. For me, the best answer is a market mechanism for a global price for carbon emission. I'm not sure if $100 is the right one, but it has to be something where we all agree. And once we agree what the price is, we need to work on this exchange. It should be a marketplace. And again, there I think everyone is needed. both a policymaker, government, and ultimately also financial market to help to create such a marketplace. That's probably the game changer. If you have this global price for something which is again a global risk, carbon is not stopping at any type of border. We can avoid some of the big downside risk which we have, this 18%, this 30 trillion, and whatever measure which we have, which works towards that helps. Now, from a growth perspective, we are super keen on APAC, and again, it's part of our group strategy. We believe that the growth is bigger in the Asian part of this world than in Europe. And that's why we shift more resources into that part of the portfolio. And if we say we shift resources, it's always, yes, we have a bigger reinsurance offering, but that also means we have more premium to invest. That's why the whole footprint as a company will clearly grow much more in the APAC area compared to Europe and US. We always will stay global. That's part of our I think value proposition. We need to diversify earthquake risk between maybe the west coast of the US with Japan. Only then we can create the value which our clients basically expect from us. That's why the globalization or the global kind of level playing field is a very important piece for us. And also we need open borders. Otherwise, if we are getting kind of too fragmented, we can't add the same value as a company.
Okay. So there's one last question from Alexandros about the CO2 pricing. $1 per ton is a nice approach. And we have some other tariffs on sustainability related indicators.
Also, we have, again, in our industry, in our company, whatever we do is risk adjusted. And probably one of our biggest assets is our own group risk model, where we model basically most of the risk which exists, and we combine it with asset side. That means if we have a pandemic situation as we have now, this has an impact on financial market. If we have a huge kind of earthquake, yes, this has an impact on certain. That's why we model constantly things, and we charge. So that means if we insure a certain risk and it has a high exposure to a certain ESG, again, if you have a very inequality in certain areas, this has a different political risk and it has a different country risk. And that means if we offer insurance or if we invest, this has a different risk charge. And that's almost kind of this is our normal DNA. We always look at it from a risk perspective. If something is more risky, SDG, if we don't adhere to it, if we don't reach this goal, that means we are more vulnerable. And this is part of our pricing. We price insurance different depending which country we cover, which company we cover. And the same on the investment side. If I invest very risky, I need to have a much better return, basically to meet the bar, which is higher. That's why, yes, we have most of the risk are quantified in our shop.
Good. So there are no further questions in the chat box. But I have one last question because you're the investment expert. I'm not. I normally fail in my investments, in my private investments. So if I have $10,000 what should I buy?
Okay.
Swiss Re or shares, bonds?
My counter question is, what is your risk profile? But put that aside. It's all about understanding your liabilities, be it as a private person or as a company. And of course, the kind of standard recipe is diversification. And we all know equity market has a high valuation right now. It's not completely unjustified if you see the stimulus. That is the biggest stimulus which we ever had in history. And of course, that stimulus should help for economic growth. And that's why you can argue it's not completely unjustified. On the other hand, it's always wise to basically to diversify your own investment.
Okay, no, I know diversification and so on, but so I agree. So I understood. So I'm fine with shares. I don't have to go into gold. Yeah. So thank you very much, Guido, for today. So the next session will be done by Ilham Kadri. This is the CEO from Solvay. I think you have a nice successor in the webinar series. But this is in June. For today, again, thank you very much from Seoul to Zurich for today's contribution, and I hope to see you sooner or later here in person in Korea.
Thank you.
Thank you.
Thank you very much for having me. Thank you.